Safeguarding are the regulatory requirements that apply to a payment institution and in what it has to do in respect of its holding of monies that it's holding for or from a payment service user. And this is obviously critically important when we're thinking about the interests of that payment service user.
The topic has received particular regulatory attention recently with some very high-profile insolvencies like the one of Wirecard or Premier FX, which have caused regulatory action.
So there are a couple of reasons why safeguarding is so high-profile and important. Firstly, unlike banks, funds which are held by payment institutions and electronic money firms are not protected by the Financial Services Compensation Scheme. Secondly, there are lots of new products and services entering into this space, and the regulators expect that some of these firms will fail. So instead of trying to prevent failure, what they're trying to do is protect customer funds in the event of failure.
Now, these rules have been around for years, but they are clearly moving up the agenda at the regulators, particularly in the UK with the FCA. Now, we saw this in 2020. We saw a study by the FCA of a range of payment institutions and how they comply with their safeguarding rules. Now, the FCA discovered some common flaws. They produced a Dear CEO letter. They produced temporary guidance indicating how firms could improve in this space.
Now, we've been focusing on the UK. However, the safeguarding requirements apply in different ways across the world. The EU obviously has a regime very similar to the UK because it follows the Payment Services Directive, but other jurisdictions like Singapore, Hong Kong have similar regimes with slightly different requirements.
Let's delve into the safeguarding rules in the UK. Now, it's worth noting that these do not apply to banks. They apply to authorised payment institutions and authorised electronic money institutions. The obligation to safeguard funds applies to relevant funds. Now, this is a defined term in the Payment Services Regulation and the Electronic Money Regulation. In general terms, this applies to funds received from or on behalf of a payment service user for the execution of a payment transaction, or funds received in respect of payment transactions on behalf of the payment service user. Under the electronic money regulations, relevant funds is defined as funds issued in respect of electronic money.
Now, the rules provide two methods by which a payment institution can comply with its safeguarding rules. There is the segregation method, first of all, and this is by far the most common route employed by payment institutions. The second one is an insurance or guarantee method. Now, it's there in the rules, but it's very hard actually to achieve that in practice because the insurance market hasn't really developed a product that's suitable.
Focusing on the segregation method, payment services providers are required to segregate relevant funds as soon as they are received. That means that they must be separated from their own funds as soon as possible once they hit the payment services provider's account. Now, there is guidance that states that when relevant funds are received together with funds that are due and payable to the payment services provider, such as fees, then there is an element of that reconciliation and the segregation happening not immediately but in the course of the day. In any case, funds should not be commingled with the funds of the payment services provider overnight. They must be deposited with a bank.
So, if you're still holding funds at the end of the day following the business day on which they were received, then you need to either deposit those funds with an authorised credit institution or the Bank of England, or otherwise hold them in certain liquid assets. Now, following Brexit, one of the advantages is actually firms have a much wider range of possible credit institutions which can hold these safeguarded accounts. It's no longer limited to the EU banks, but it could be a bank anywhere in the world which meets certain requirements.
Compliance with safeguarding rules really is a critical risk area for payment institutions. Now, we saw in the February 2021 decision of the FCA in respect of Premier FX that there would have been a substantial financial penalty imposed in respect of its breach of safeguarding rules had it not entered into insolvency, and instead that firm was subject to a public censure. But we can see from those Dear CEO letters that the FCA is shaping up to hold firms and their senior managers accountable for compliance in this area. And then if we look across to other types of regulated entity which are subject to client money and client asset rules, we can see a string of enforcement cases there, and there's no reason why the same thing won't develop also in respect of payment institutions and their compliance with safeguarding rules.